I see some people starting to come in. Those that are coming in, give us just a minute or so as this gets populated by all of you wonderful, smart, intelligent investors. Uh, Certainly appreciate those that keep on attending these webinars on a regular basis. This should be a great one with Axel Merk, James Holman on the gold side of things, gold miner side of things, obviously. For those that are attending this for the CE credits, this is eligible via the CFP board. I will be emailing you after this, either later today or early tomorrow, to get your information for the CE credit side of things. So stay tuned for that. If you are an advisor and you are in an office with other advisors, please, please, please do me a favor and tell your fellow advisors about this live webinar. And of course, we want to make this as interactive as possible, which means if you want to ask questions, put in the chat, put in the Q&A. I'll come in towards the end of the conversation and bring those up to both Axel and James. And with all that said, let's get right into it. My name is Michael Guyette, publisher of the Lead Lag Report. This is a sponsored webinar by Merk Investments. I will let these two fine gentlemen get into all the nuances around gold mining and why it's still very much an opportunity. So maybe James, I'll start off with you and then go to Axel.
Thank you. I just have to switch headsets.
Are you bringing up the presentation?
There we go. Yep. I was on a call until a few minutes before, and my battery said I'm out. Well,
Yeah.
Welcome everybody. Thank you, Michael, for doing this again. I think those are good discussions. We will give a little bit of an update of what's happening in this super interesting space. Jamie will take you through several slides. As Michael points out, this is supposed to be interactive, so please ask questions. We have wonderful disclosure. Please learn that by heart. We will quiz you on that afterwards. Needless to say, it's a volatile space, right? And so this is not for the faint of heart. This is not a fixed income fund. This is a gold mining fund that has significant volatility. Let me pass it to Jamie. For those who don't know Jamie, Jamie joined us about 3 years ago from Invesco Oppenheimer, and he's a geologist by training. He has been friends with the portfolio management for some time. Peter Malides, who cannot make it unfortunately today, joined us in 2019. Peter has been managing the portfolio since April 2019. And Jamie, why don't you take it from here?
And, thanks, Axel. So if for those investors that have followed Peter and I, if we've managed this portfolio, you know that we are very much in the weeds and very much bottom-up investors focusing on the fundamentals. We do a lot of venture-style investing, getting in early with management teams that we know very well, following them along, going into the due diligence of the assets, looking in from the geology perspective and engineering perspective, and really vetting the assets from a technical side. That being said, I think it's at a time that maybe we step away from the weeds here and look at the forest instead of just getting stuck in the trees here. So what I did is I just wanted to kind of just give you guys an overview of where we are in the gold mining landscape, from where the price has gone, and then also where the earnings are expected to go and where they have been, and what that says about the gold market, and then also looking at some of the sensitivities of the gold miners to the gold price. And then in addition, maybe thinking about what other dynamics might be affecting the gold mining sector. So to start out, there's a very simple chart in front of you, and it's just looking at the average gold price over the last 3 years, and then the average gold price for 2025 so far. And as you can see from that chart, we've had incremental step-ups every year. In the last 2 years have been very large leaps, 23% in 2024, and then we're up 24% in 2025 here on an average basis. And then the jump from 2022 to 2023 was 7.81%. And so as we all know, that miners extract gold from the ground, they sell that gold. It costs some money to get it out of the ground, and the money they make is the difference between the price that they sell at and what it costs to get that metal out of the ground. You know, and when we see a radical increase in the gold price like we've seen here, um, it's positive for margins because these businesses don't adjust to the gold price on a year-by-year basis. These mines are planned, you know, 4, 5, 6 years in advance, and the studies and the you know technical work that is done on these assets has been done, you know, has been done 3, 4 years ago for a lot of these assets, where they're really building the economic base for these assets around, you know, a $2,000 gold price. And so yeah, we will, you know, be expecting large margins. So let's go to the next slide. Um, yeah, so this is an interesting slide, and it's looking at you know, we have a few different charts going here. So we have in white we have the S&P 500. In orange we have the Arca Minor Gold Bug Index, HUI index. And then in blue, we have S&P best EPS estimates on a forward basis. And then in purple, we have the Arca Gold Miners expected earnings as well. And so the reason I pulled this chart is it gives you an image of how dramatic the increases in earnings within the gold mining sector are. And it's I have it normalized at 0 starting in 2022. But the increase in earnings in the EPS from 2022 to the present in the gold miners is 86%. You know, so that's a dramatic increase in earnings, and that's in comparison to the S&P, which have experienced earnings growth of around 15% from that same time period to the present. And as you can see, the S&P has, on the time period that I picked out, has slightly actually outperformed the gold miners. And that brings up a question too of, you know, why that is. Why is it that, you know, we've seen these dramatic rise in EPS, you know, over multiple years, and yet the gold miners, although they've performed well recently in the last year, they are not keeping up with the earnings that we expect to come out of these gold miners going forward. So I'm going to delve into, you know, some explanations of why this might be happening, and then also, you know, why it might be a good thing for investors going forward. So let's go to the next slide here.
Just for my compliance sensitive ears, just to be clear, the part of what we're talking about are estimated earnings. There's of course no assurance that they have those. But to just give some flavor to that, just briefly, in the last cycle that we had, in addition to the price of gold rising, you had commodity prices more broadly rising, notably the cost of energy. And mining on the producer side is very energy intensive. This time around, the price of oil hasn't gone up as much or even come down. And similarly, because other commodities haven't participated in this rally, the cost of labor hasn't had as much pressure. I mean, it's always tough to find labor for mines, but it's not as tight an environment as it had been. And so in my assessment, those earnings estimates are quite realistic that are in there.
Yeah, I know. Just to add on to what Axel's saying, you know, it's getting into some of the reasons going forward. It is, you know, I don't want to get overly exuberant here, but it is a bit of a Goldilocks zone for gold miners here, where you have, like, you know, tepid inflation on the cost side for the miners. You have the energy prices going down, and you have a radically higher gold price. Like that's what you want in miners. That drives margin, you know, and that's, you know, very different than what happened in 2020 when we saw the dramatic increase in the gold price going into the COVID era. And what followed there was a dramatic rise in the cost of operating these mines, and it pretty much you know, matched the gold price and such that you didn't see any increase in margins. So I think part of what is going on here, just to kind of jump a little bit further forward, is that investors they're going to want to see the print of increased earnings and cash flow driven by this because they've been burned several times before. But there's some other aspects that I want to talk about as well. So let's go to the next slide.
I think I put it up, or do you want to go to the next one?
Oh, okay.
Yeah.
Yeah, this is so this is looking at earnings on a much longer basis. You know, so we're looking at it from 2005, and we're really looking through the mega cycle, the super cycle that happened from 2000 to 2011, where, as Axel said, that was an environment where we saw every commodity raging as China was coming online, building out all their infrastructure, building out all the housing that we're now dealing with the fallout of. And through that boom, we saw that the miners, they returned, they performed well relative to the gold price in the first part of the gold price move. But as we got into the later years of the gold price move, investors, picked up on the fact that, hey, the cost of producing this gold is going up just as fast as the gold price, and the capital allocation decisions of these gold miners is becoming quite disastrous. And at the end of the rally, we saw the gold price significantly outpace the gold miners. And then as we rolled over, the debt that was put on the balance sheet by the miners became apparent and started to weigh on them as, we saw gold price going down, margins collapsing, and that led to a big drawdown in the gold mining stocks. And actually, we're still living with the legacy of this because the gold mining industry has still retained the conservatism that era brought about. And so we still see companies doing share buybacks, like Endeavor Mining instituted a share buyback just the other day. And the debt levels within these companies are significantly less. And they're being more conservative with M&A. So it feels like, you're kind of at the beginning of a cycle with the conservatism that you're seeing within the industry. So let's go to the next slide. Yeah. So another reason why I think that the gold miners are not performing, as well relative to the gold price as they have in the past, and the sensitivity is not as great as it's been in the past, is that, as we all know, passive flows are what dominate capital markets today. I can't remember the exact number, but I believe like about 65% of global capital markets flows and assets are controlled by passive money. And so the biggest passive indexes within the gold mining industry are the GDX, was the junior gold mining, and then the GDX. And what I have here are the number of shares outstanding for that ETF. And so just if you're not familiar with ETFs or the mechanics of them, when an ETF has more demand for shares than are on sale, they go through a creation where they add shares and then go into the market and buy the underlying assets of the portfolio. And then if they have redemptions, they have more selling than they have shares to buy. They actually they retire shares and then they sell the underlying assets into the market. And so what we're seeing here is the GDXJ. It was going along with kind of a ebb and flow of share count, but then we hit about March of 2024, and we just kind of went on this monotonic decline where we've seen the shares outstanding decline nearly 30%. So let's go to the next slide.
Just that was a great summary how ETFs work. There are some important nuances. We're not going to get into them here, but if there's any ETF buff out there, I'll be glad to jump into those nuances if somebody does care. Yeah.
And then this is a similar to the GDX. So this is the larger gold miners, and this ETF is larger in AUM as well. And we see a similar decline where it's down 28% from the beginning of 2024 to the present. So those are pretty dramatic rises. And the question is, in a rising gold price and an outperformance of the of gold and gold miners, why is that happening? And so if you historically think about who invests in the gold miners, as Axel alluded to at the beginning of the presentation, this is a sector that's not for the faint of heart. It's a very, very volatile sector. And, so I think that you get a lot of investors that have an appetite for volatility, and at the same time, they have an appetite for, I would say, uh, for a currency that can't be debased, like gold, and they're part of the real money crowd as well. And that the overlap of people that like very volatile things and are part of the real money crowd might also coincide with the Bitcoin crowd. And so let's go to the next slide. I don't want, this is, I have no statistical evidence of this. It's, and I have no statistical evidence of causation or correlation or spuriousness of this relationship. But the one thing that I thought was interesting to point out was that the same time that the gold miner ETFs started to see significant outflow was at the same point at which we saw the first spot Bitcoin ETFs come onto the market. So this is IBIT, and as you can see, these obviously they started out as 0 shares because it was the beginning of it, but they've seen a dramatic increase in shares outstanding. And then we go to the next. Oh, I guess I thought we had 2 of those. But anyways, there were several ETFs that came out during that same time period that saw dramatic growth. And maybe that was part of the sucking sound out of the GDX and the gold miners for people that like, liquid volatile plays, which the gold miner ETFs are. So let's go to this is the first slide. And so how does this, I wanted to look at like how this translated in uptrending markets to the beta of the gold miners to the gold price. So this is looking at the current run. So we're looking at a time period from January 2nd, 2024 to May 15th, 2025. And it's just doing a standard regression where we're trying to find a beta to look at the sensitivity of the junior gold miners. So I'm using the GDXJ index to the gold price. And so we get a raw beta of 2, which which is essentially saying for every percent up in the gold price, we would see 2% rise in the GDXJ. But how does that relate to the sensitivity that we've seen in the past? So we can go to the next slide. Here's looking at October 2015 to February 2017, and we had a rise in the gold price over that period, and we saw a beta of nearly 2.7, so significantly more.
And by the way, the people may have been shocked about the volatility in recent weeks. That's kind of it's not exactly normal, but the quiet period is the unusual thing in the gold mining space. It doesn't need to be quite as radical as in recent weeks, but yes, there was an extended period that had less volatility, and those interested in speculation had other things to dabble in, which of course becomes a self-fulfilling prophecy, right? If a space is less of an interest, it might become less volatile as well.
Yeah. So we go to the next slide here. Here's 2019 to 2022. So this is the run up during COVID. And again, you saw a strong correlation to the beta was 2.5. So you got, what is that, nearly 25% more juice on the upside from these. So that's, and I guess what I'm surmising from that is that I think you have 2 things. From a fundamental perspective, you would expect that the gold miners would have less of a correlation or less of a beta to the gold price if they had higher margins and less debt. But I think that is less of a reason. I think more of the reason is that you actually have seen this outflow in assets into the sector. And it's not only within the ETFs, we've also seen it within a lot of the mutual funds. I have a lot of peers who manage large mutual funds, and they have seen outflows even with the strong performance that they've seen recently. So you've got this general outflow out of the market that I think is dampening the upside beta to gold that the gold miners normally exhibit. Yeah, and so the question becomes, what does this say for the gold miners going forward, and how does it influence our strategy? what it's led to is that, the fundamental thesis for a lot of these gold mining companies, if they were, you take them out of the gold mining space and put them into any other industry, the way the market is valuing them, there's a much more compelling value orientation to the market now than there has been in the past. And so you've got this where you've got, lower debt within the companies, and you've got a more disciplined backdrop considering some of the poor capital allocation that's gone on in the past. And so I think that the ability for these companies to deliver margin into this higher gold price is higher, and it's that being said, it's not an easy industry. And so finding the companies and the talent that can do that is that's our job, and that's what we focus on. But we think that there's a great opportunity for that to happen. And I think that it's going to take the gold miners delivering those margins and delivering into those, EPS expectations that we see for the gold miners to continue to outperform. And the interesting part is that for us to have year-on-year increases in earnings within the gold miners, the gold price would have to drop dramatically. I think it would have to drop like, 30% or something, such that we had a gold price that was below the average of the gold price last year. So our ability for these companies to generate cash this year is very significant under the most dire of circumstances for the gold price. So fundamentally, we think the sector is very healthy. It's got some of the largest margins that we've seen, and we're expecting great things going forward out of the gold sector this year.
Expecting great gains. Let's put a big qualifier on that.
Yeah.
No, I
Not
mean,
my
again,
compliance. Axel also serves as the chief compliance officer.
No, I do not, just not for the record, but I'm trying to do my part here. We do have an external compliance that looks at these things. No, the point though is that obviously we may be biased, but we are optimistic. But let's maybe talk. And the reason I put up the ASA slide is what we do is different from these ETFs that was shown there, and we're not giving any value judgment on those ETFs, but there's huge differences. And one of the challenges in the larger gold miners is they've gotten so large that it's difficult for them to replenish what they're mining. Right? I think, Jamie, is it like 5 million ounces that the larger ones are mining a year? Is that correct?
Yeah, I think at Newmont, after the acquisition of Newcrest and Goldcorp, is up to like, God, 7 to 8 million ounces. Yeah. And
yes, and so you need to replenish that stuff.
Yeah.
And so what happened to just Jamie talked a little bit about what happened in the last several years, but in the previous bull market, they overinvested, acquired a lot, and the earnings didn't rise. And so investors complained and said, hey, get your act together. And that's precisely what these companies have been doing. They have been fixing the balance sheet. Well, when you quote unquote fix your balance sheet, it is less leverage, and you provide less of a leverage to the price of gold. It's one of the factors that's reducing the beta in these companies because they're more conservatively managed than they had been before. But the other part of that is that Barrick just changed its name away from Barrick Gold to, is it just Barrick or Barrick Mining? Or what's the new name of Barrick?
I think it's Barrick Mining.
Yeah.
And they had the best ticker in the world. They had the ticker GOLD.
Yes, and so the reason they did that is because in order to sustain themselves at these production levels, they need to invest, or they've chosen to invest in these very large copper gold projects. And long term, they may work out fine, but they have substantial operational risks to do things on time and on budget. And it really changes the sort of risk profile of these companies. And there are fewer opportunities for investors to kind of do the traditional gold investing. And in many ways, what we do in ASA is, at least we believe, and of course we're biased, is the proper way to invest in this space. And do you want to go just on a very high level, kind of describe what we do, Jamie?
Yeah. So, I mean, I think that our sweet spot in investing is looking to invest in companies that ultimately can become 150,000 ounces to 500,000 ounce producers. That puts them in kind of the mid cap category. And the reason we like this level of production is that, that the way that the way that geology has endowed the earth with gold is that you can find gold deposits that are 150,000 ounces and can produce for 10, 15 years. And you can end up, replacing your reserves, and you can also end up growing your company when you're that size and showing, as we talked about, earnings growth. I'm a believer that over the long run, what drives stock prices are earnings growth, right? And if you look at the S&P over the long run and, earnings growth, they track pretty closely. And so we like to see companies that, even despite what the gold price is doing, if the gold price is flat, we want to see them able to increase earnings. And so the way that we kind of get, really get exposure to that and get the most bang for our buck is we like to back teams from the very beginning, from their infancy. So we're doing sort of venture style investing and helping companies and teams find assets and work with them to get those assets online and developed where they're growing from, micro cap companies to, mid cap companies where there's also this accretion in multiples that's associated with the liquidity and the size of the companies as they grow as well. And the other thing that we're able to do too is that we can be flexible with where we invest in the capital structure. Given it's a closed-end fund, it gives us a great ability to invest in, illiquidity, but also we can invest in convertible bonds, which have a nice risk profile of providing income. Yet then on the upside, you can convert those into shares and get the equity upside. Then we also are able to invest in preferred equities, which have a similar payout structure. And then we can invest in private companies. Sometimes there's private companies that come along like you would similarly see in other industries like the tech industry, where there's great growth in the private side and companies choose to stay private. And so we have some investments like that as well. And yeah, I think that it's a dynamic approach where we can be long-term partners with the operators, support them as they're growing these companies, yet also be able to utilize the volatility in this sector to get out of investments when we feel like they're fully valued and redeploy that capital.
Yeah, and that may sound very fancy, but we actually do that. We find these companies that we fall in love with, but Peter and Jamie have been willing and able to sell them. We have a fixed pool of capital, need to redeploy that capital. Selling is at least as difficult as buying is. A lot of investment managers know how to buy, but they don't know how to sell. And the sort of performance that we show here, the reason we show since April 1, 2019, is because that's when Peter started managing the portfolio. And the return, I think, speaks for itself. This is through March 31st. There's been significant volatility since, so the return has come down since. The relative performance is still applicable as that, but obviously the return with this volatility does change on a daily basis.
Just to talk to that as well too, is that we've outperformed, and the sector within the gold mining that has struggled the most has been the smaller companies, and that's actually where we've been investing. So we've been able to select companies on the smaller side that have actually significantly outperformed in an environment that has been actually adverse from a share price performance to the smaller companies.
Yeah. And by the way, one technical way of phrasing that is the gold mining sector has the greatest dispersion of returns of any S&P sector, which is a fancy way of saying active management really matters in this space. And the big ETFs just are somewhat constrained in that. And it doesn't, of course, mean that we'll always pick the right companies. But I think Jamie and Peter say the scarcest resource in the space is good management. And it's in that context as well, when Jamie talks about this is quote unquote venture capital, well, it's venture capital light, right? Most of what we invest in is public companies. We are able to invest in some private. The advantage, and similarly as in the venture capital world in technology, the teams that are most likely to get funding are teams that have proven that they can do it before. And by the way, well, some of them are, but a lot of these management teams, they're not gold bugs. They're engineers. They know how to get gold out of the ground. They know how to run the difficult processes of getting the permitting done, and how to make sure that all the stakeholders are taken care of. And that is a skill that comes with experience. And so that's why we tend to deploy capital to them. And of course, not all these companies will succeed. But the good news is that should they not succeed, the gold is still in the ground. Obviously, if there's a management change, sometimes there's dilution and whatnot with new capital raises. But it's a fascinating space because there are opportunities. The market is shifting sometimes, and obviously sometimes opportunities are a little different. One chart I wanted to show you is that on a risk-adjusted basis, ASA has also done very well. The top line here is a fancy name of saying that's the price of gold in especially in institutional settings. One uses a gold index, which is allegedly a better way of representing it, but it's pretty much the same thing, except this is actually a futures contract with the cash reinvested, so that one gets some sort of interest earned on the cash. But it's no secret that the price of gold on a risk-adjusted basis has gone quite well. Last year, ASA outperformed the price of gold, and very, very few people did that. Of course, in a bull market, it is possible, and many people would say expected that the equities outperform. It just hasn't necessarily happened. There's another table we ask you to study by heart because we'll quiz you afterwards. Now, this is we'll be more than happy to give you a copy of the presentation. This is like a complete table of various periods, how ASA has performed, and also versus other mutual funds. And there's the bluish is outperformance, the white is not. And you see the weak period was 22-23. That is when the junior miners really got hit, and the exposure to that space hurt us. Jamie and Peter repositioned that portfolio as part of that period to take advantage of the growth phase that we anticipated. And I must say they have done that successfully so. And so it's been again, ASA and gold mining is not for the faint of heart. What ASA does, it provides access to the junior mining space. And notably, it provides access to these deals. Often when these deals get announced, there's a pop up in share price. Rather than the market being upset about the dilution, they're happy that there's funding available. All these junior companies often get funding only for a year or two. And when one participates in these funding rounds, we sometimes can have some influence on the structuring of that. Warrants are often provided as part of that. And most investors on their own just can't participate in these things. And so even though we are super transparent about what we hold, this is taken from the website. This is of March 31st. We publish these things as on a monthly basis with some delay. And we would very much discourage you from just copying what we do, because not only you're not going to be there when we sell, but also you're not going to be able to participate in these deals when they come.
To make a deal happen, because oftentimes the component it's missing is the capital that's willing to jump into uncertain situations, and that's certainly something that mutual fund managers and ETFs either can't do or aren't willing to do.
Yeah, on the mutual fund side, they have to think about redemptions all the time. Similarly, they got burned in the previous bear market. They would sell the liquid securities, and that would tilt their portfolio in a way towards the junior miners that they didn't appreciate. And in a closed-end fund, we think for the gold mining space, the closed-end structure is just a very, very nice structure. On this chart, there's a little breakdown of what we invest in. Just to clarify, it says 82% Canada. That's incorporation. That is not where the sites are. Canada is a preferred place because of the jurisdiction. Australia is a popular place as well. And so that's important. Some of the securities are listed in the US, but they're not incorporated in the US. Also, on the stage of development, it should keep in mind that this is when they have started to produce, kind of they move up in the ranking. The short of it is there is a lot of exposure to the junior space, and I wouldn't get too tied up on the exact breakdown on the decimal point. Especially if you look here that we have 67% in producers, while if you look at the stage of development, some of them have just started to produce, and that's why they make it up a level. And maybe Jamie, if you want to just briefly touch on one company or maybe two companies on, we've not done this for several years, where we've helped them grow, and what that means in a good case scenario. Obviously, not all companies are like that, but I heard you.
Yeah, I guess the obvious one is our largest holding is G Mining Ventures. That's a company that we backed from when they were a shell. And what is a shell? A shell is just a publicly traded company that doesn't hold any assets. It just has a management team. And so this is a management team that came out of G Mining Services, and G Mining Services is a engineering firm that had a great track record of building mines throughout the Americas. And they decided to jump in and start a mining company themselves. We had a relationship with them, and so we funded them in the shell, and then we continued to fund them as they looked to purchase an asset from Eldorado Gold. They just went into production recently, and then they have another asset that's going to be coming online the next couple of years. But that's been a very significant win, and I think it's emblematic of kind of the investment process that we go through in some of these companies.
And just to allude to, you see a long tail here of small positions. Many of those are warrants, but again, right, not all these businesses necessarily make it. The idea, similar to venture capital, is that the winners make it big, and so that is very helpful. The other thing here, you may notice here, private 5.5%. Those tend to get valued based on the most recent transaction, which kind of works both ways. As the rest of the portfolio appreciates, it holds it back, and on the way down, it might be a dampener. We do have an internal valuation team that takes the regulatory environment into account to make sure these are valued with the appropriate standards. If we were to think that they are worth less than the most recent value, then we would have an obligation to act. Let me pass it here to Michael to open it up to some Q&A while you read a little bit more disclosure. But Michael, if you want to.
I was hoping to read the disclosure personally. No, it's clear. Okay, so from John Blair here, this is more sort of just thoughts on the space, but what's your preference or balance between owning the miners versus royalty streaming companies? Which of these two do you think offer best value at this time? Let's talk about that in the context of ASA, obviously.
Yeah, Jamie, if you want to take that.
Yeah, I mean, the royalty companies have performed relatively well. Obviously, they don't see the margin expansion as the miners. And in this environment, I tend to lead towards the miners because, like I said, I think it's a Goldilocks zone for the miners. It isn't always a Goldilocks zone for the miners, but we've seen the cost inputs to mining have really levelized, both on the labor side and then, as Axel alluded to, on the energy side with the cost of the price of oil going down. So I would tend to lead towards the miners at this point.
It's not asked on the Q&A here, but can we talk about how tariffs impact this space?
Well, obviously there was big volatility right after "quote unquote" Liberation Day. Let me give you a couple different answers to that question. The first one is we saw a volatility shock, which brought everything down, including the miners that had increased significantly. That said, the price of gold very quickly rallied again, and I have an article I wrote actually before Liberation Day, where I do believe that the entire plumbing of the financial system is changing and the price of gold is benefiting. And the reason the plumbing is changing is, I like to give the Trader Joe's example that I think everybody has heard of, where you have a trade deficit with Trader Joe's. Well, if you were to force that into balance, not only will you buy fewer goods, but there's less money making it to Trader Joe's. And so putting that on a national scale, when you throw a wrench into global trade, financial flows are impacted, and notably foreigners will finance US deficits less. That's just a question of math. It's not a political statement. And the rising long-term yields, I think, are a direct reflection of that. Now, clearly, the administration, they're not dogmatic about this. There's some flexibility. I happen to think the 10% baseline is at least my baseline, what the administration wants, and then some punitive tariffs or higher tariffs for some countries. That, to me, does change this plumbing. And in many ways, it puts the exorbitant privilege of the US at risk, because historically, the US is kind of the bank of the world, where people borrow cheaply in the US for higher returns abroad. And not only do Americans do that less in this context, but foreigners will borrow less in the US. And we see the latter, that normally in a risk-off environment, the dollar would rally. And that's because borrowing in US dollars is a short on the dollar. And then when volatility spikes, that's a short squeeze that reduces the sort of leverage. Now, more broadly on the tariffs, most of the machinery for mining is produced or manufactured abroad. And so for US miners, the cost of the machinery goes up. That said, far outweighed is all that for US production anyway, is the executive order on strategic minerals. Gold was elevated to a strategic mineral in that order, that on federal land, the permitting process is substantially reduced. Now, most of the companies we work in don't operate in the US, and I'll have Jamie chime in here in a moment of what we do have in the US. And Jamie, you have otherwise a more kind of a agnostic or neutral view on the miners, I believe, because it doesn't really affect the miners themselves. It does affect the price of gold too much. But Jamie, if you want to talk both about the production or work that our portfolio does in the US, and then your broader thoughts on tariffs.
Yeah, so a lot of it, the only production, we only have one producing asset in the US, and they haven't really been impacted at all by tariffs. Maybe there could be some impact on the exporting of concentrates. That's to be determined. And then the other companies that we hold within the US are still like in an exploration stage, and they've actually benefited from the administration because there's been some streamlining to the EPA and the National Forest Service on the permitting process, and so that's been helpful for a lot of the U.S. companies. And yeah, actually, when Trump came into power, there was a lot of these U.S. miners that were struggling with permitting issues that you saw increase in value quite a bit.
And any thoughts on international miners? They're not particularly impacted by the tariffs, right?
Oh no, I don't think they're impacted at all, really. I mean, because
exactly.
we don't produce anything in the U.S. that that the international miners are buying as inputs.
And of course, the price of gold is what it is, right? And that's also, I mean, that's influenced by tariffs, and that affects the margins. But yeah, so comparatively speaking, gold miners are better off than many industries.
How about sort of the state of consolidation? You mentioned the small cap side of it, or smaller miners. Anything to suggest there might be sort of a wave of consolidation coming?
Jamie?
Yeah, I think we've been seeing that. We've seen quite, it's kind of been consistent with, M&A. We've still seen, I mean, the big thing that went on last year within the gold sector was that Newmont shed some of their assets from the Goldcorp acquisition. And I guess it was, yeah, pretty much just the Goldcorp and the Newcrest acquisition. And so there was some opportunistic purchases of those assets. And some of the people that, some of the companies that purchase those assets have performed very, very well. Particularly Discovery Silver purchased an asset. There was an operator who runs Discovery Silver who had a long time relationship with the mining operation that they purchased off of Newmont, and was very familiar with the jurisdiction. That's done well. And then Orla Mining purchased another asset off of Newmont, and they've performed very well off the back of that. And the issue with acquisitions going forward is that there's not that many assets left of any substance to be acquired that are actually teed up and permitted or close to permitting that could be put into production. So that's an interesting side to watch, and to see whether the larger miners, how far down, not just market cap, but development stage will they go? So how far, how far away from production will they be willing to purchase assets? And then further mergers and acquisitions, I think that we will see that. As I alluded to, the fact that global capital markets have become more passively driven, and most of that passive money is market cap weighted. It does incentivize larger companies. You can get a bit of a higher multiple if you're a bigger company. So if you have, two 200,000-ounce producers that emerge to become a 400,000-ounce producer, they may be included in more indices and just have more natural buying from passive flows as a result of that, which has been happening. And then also can be some synergies between the assets as well. So
and by the way, that's part of what we are banking on, so to speak, as we help institutionalize these assets to participate in those higher valuations along the way. And part of the goal that we do have is that we're not just dependent on the price of gold. We talk about the company individual catalysts, and that in itself, right, the potential to be added to indices can help. Australia, by the way, is quite index driven as well. And so helping these companies grow and being added to these indices helps. Obviously, also in future funding rounds, bigger investors might join, creating more liquidity for these securities and whatnot. And so that's all part of the reason, I believe, why ASA has done very nicely compared to its peers.
Just as a reminder, folks, for those that are looking for the CE credit, I will be emailing you either later today or early tomorrow to get your information. So look forward to that. I think final question on my end. Let's talk about how it fits in a portfolio, ASA, not investment advice, but from what you see or hear from other financial advisors and allocators, I'm going to assume they view it more of a satellite position, but in what kind of ranges, how should they think about pairing it?
Well, the thing to think about, we've had many more calls over recent months, not just because the space has done well, but because investors have also been disappointed with some of the major ETFs. And for the reasons I alluded to, right, they have less leverage to the price of gold. Jamie showed that beta chart or the charts, and these companies just haven't performed as well. Of course, it doesn't mean they'll never perform well. And clearly, an ETF is very different from a closed-end fund. An ETF is at net asset value, whereas a closed-end fund trades at a premium or a discount. By the way, I would discourage anybody from putting in a market order in ASA because there is liquidity, but it's not huge. And by the way, since we talk about investment, a few things briefly to mention. ASA is actually a Bermuda-based company. It acts in the US as an investment fund and is available on the New York Stock Exchange, but it means for tax purposes, it's called a passive fund investment company. In a qualified retirement account, it makes no difference. There are some tax elections you might want to do in a taxable account. There's more information on the website. Reach out if you have questions on that. And then I should also mention for everybody's attention, there's a lot happening on the corporate side. If you have any questions on that, please reach out to the board to help address any of the questions you have. But as far as kind of fitting in the portfolio is concerned, one of the quote unquote positives about the very significant volatility is that a small allocation gives you a lot of bang for the buck. So you can get a lot of diversification with a small allocation. I'm on record that having been an insider buyer, and say I eat my own cooking, and so from that point of view, I like the investment, and I have a very sizable investment. That doesn't mean such a sizable investment is appropriate for other people, and I have to be wearing the compliance conscious hat here that I can't, of course, give specific allocation advice to anybody else. And the way I look at allocations is in terms of risk. What risk can you afford? And in that sense, the volatility of recent weeks is something you may want to consider. The fund is not always going to be that volatile, but as the last few weeks showed, it is certainly possible to be that volatile. And so if you can't stomach that volatility at a significant exposure, it means you might want to allocate a little bit less if you're considering exposure. Back to you, Michael.
That's, I think, a good place to wrap this webinar up. For those who want to learn more about ASA, Axel, where'd you point them to?
ASAlimited.com is the website for ASA. Merkinvestments.com is our corporate website. From there, you can also get to ASA. While I have you, we have a newsletter, either on ASA or Merk Investments. You can sign up to stay in the loop. If you are on social media, follow me on Twitter. I can't tweet about products on social media, but I will chime in on what's happening in the gold and gold mining world. And so if you want to hear any of that, at Axel Merk is the handle. And then separately, of course, we are very open to talking to shareholders or potential shareholders directly. So if you have any questions, anytime, feel free to reach out. We try to have an open door policy.
Appreciate those who attended this webinar. Again, if those looking for the CE credits, you'll get an email from me shortly. Make sure you learn more about ASA beyond this webinar. And thanks to Axel and Jamie. Thank you both.
Thank you, Michael.
Thanks, guys.
Cheers, everybody.